For many of you that are starting businesses today and are in the housing market, my goal today is to get you to focus on the housing market and the implications of changes in the market that could actually impact your businesses. Because you guys are really busy starting companies, and you're not really focused on the dynamics that could, in fact, impact your businesses today. So my goal is that none of you are going to look at your phones. You're going to be really excited, and you're going to listen to this presentation. So we'll see if I can do that. At the end, you'll tell me if I did that or if I did it. Okay, so there's a lot of material to go over, but first, just 2 seconds on myself. Our firm, I've been covering housing for 30 years, and we really are the comprehensive, wait, I want to go back one. Oh, now I'm screwing up. All right, how do I go back the other way? Okay, I got it now. Okay, so this puzzle, so as you see, what we do that's different than a lot of research firms do that cover housing, we focus on all aspects of housing, whether we're talking about the mortgage market, the home building market, the rental market, and we are able to collaborate and triangulate all the pieces. And that's really what makes us unique. And we called the top of the market in 2005, which was allowed us to go start our own firm, leaving Credit Suisse, and we actually called the bottom in 2012. So we do a lot of deep dive thematic work, and right now I'm going to take you through some demographics that are really important to housing. So demographics, when we think about it, many of you in this room, how many in the room are between 20 and 34? Raise your hand. Wow, a lot of you guys. So if you look at what we have today population-wise, in 2018 there were 67 million 20 to 34-year-olds. By the end of 2030, there will be roughly 68 million. So that's not a lot of growth, obviously, it's pretty flat. What's happening is, guess what? The millennials are aging, and they're aging with that 35 to 44 group is going to see significant growth. Why do you care? Why does that matter to you? Well, if you're in that 35 to 44-year-old bucket, in many cases, lifestyle decisions start to dictate what type of shelter you want. So the multifamily market had been tremendous beneficiaries of millennials that were aging into the 20 to 34-year-old group, and there was tremendous multifamily development. In every city, we see cranes everywhere. And that was a beneficiary that was a major tailwind, but now it's going to be generally a headwind. It's not going to be growing. Whereas the single-family market now is going to be the beneficiary of this growth. If you see, looking at, believe it or not, lifestyle dictates what shelter you choose to live in. 82% of married couples with 2+ children live in a single-family home. I'm not delineating whether they own the home or rent the home. Right now we have 16 million households that rent, but the importance of understanding what does this mean? So if you're in the single-family market and you are starting a company that's going to be a beneficiary or in that single-family end market, that's a big tailwind and real growth opportunities that you can capitalize on. So what I want to show you now, for 25 to 34-year-olds, there's a lot of misperceptions in the market, and the media doesn't really appreciate or understand that millennials actually are buying. So what you see here is for the 3 categories of shelter, is that actually the for-sale market for that category of 25 to 34-year-olds has actually been growing. So they're moving into the existing and or new home market, whereas you can see that the single-family rental and the multifamily market have generally been trending somewhat lower. And that is really to suggest that we are seeing growth despite the perception that all millennials want to walk to work and they want to live urban, and that home ownership is actually not going to continue to grow is not correct. One of the problems we have, and this is somewhat of a busy chart, but we're not building enough homes. The United States right now has a deficit of available homes. Vacancy rates are below normal levels. We're only completing about, in this case, through 2018, 865,000 new starts when we need more than 1.1 million to satisfy household growth and demolition. It doesn't even account for obsolescence. In the multifamily market, we're actually above normal. And for that, to understand that, what does that really mean? That means that we should have an elongated cycle for more starts to provide to close the gap that currently is pretty substantial at 25%. One of the things that had been really fun, actually, going back and analyzing this cycle coming out of the 2011 trough, housing starts in 2012 grew 25%. But then we kind of hit a road bump because the Bernanke rates spiked as the QE was actually now starting to decline. And what you saw was the housing market really didn't grow pretty much after 2012, and there was a lot of speculation that, again, homeownership was dead. what has happened is the builders weren't willing to build in tertiary markets, which is, San Francisco being the, call it A location. Builders typically will go to the B location, the C location. They weren't willing to do that. And they weren't willing to do that because they were afraid that the mortgage market was too tight, which it was at the time, or that banks weren't going to be willing to lend them. Well, in 2015, I stood on a stage and said, hey, you guys, if you build it, they will come. And surely by 2016, so roughly only 3 years ago, did the builders finally start to pioneer. So interestingly, the Brookings Institute shows that the growth rate for population looking at urban core growth rates has actually been on a growth rate is decelerating compared to the exurbs is in that third ring, is actually been growing. The only reason that can happen is because the builders are pioneering again. They're willing to finally go out to the exurbs where there's a significant deficit for affordable product throughout this country. Home ownership rates, despite, again, some misperceptions, have actually been increasing at the greatest rate for that group of 25 to 39-year-olds. And we believe that trend will continue because guess what? People, despite what everybody thinks, continue to get married or cohabitate and have children. And that tailwind I referred to earlier will push that homeownership rate continuing to move higher. So what's going on in the housing stock? One of the great opportunities, if you're not capitalizing what I'm going to talk about now, you should be, is that we have a big problem in the United States. We have an old stock. It's not what you millennials want. Sorry to offend any millennials, but this is a do-it-for-me crowd, not do it yourself. So what you have is old stock that you don't want. In fact, Zillow did a survey, said what is the most important consideration for buyers, millennials, in the market when they're looking for a home? Number one consideration is they want new. So we have a 43-year-old stock. Over 60% of the stock is actually older than 20 years old. A broker will have a customer who's contemplating selling their home, and they'll be like, well, your house is pretty, dated. And when was the last time you upgraded the kitchen? Or you did something, put some, more carpet or new cabinets? And they'll be like, I did the kitchen 10 years ago. They're like, yeah, that's dated. So what you need to have is smart homes, open floor plans, not boxy that we have in a lot of the product today. So we have a seller who's not willing to capitulate, and therefore it's stuck. We need to redevelop these homes, and that's a major opportunity for fix and flip and hard money lenders that are providing financing to help this aging stock actually provide more shelter for people. So multi-generational is another issue, but I think is an opportunity. If you think about the millennials today, the generation, whether boomers or Xers, are sandwiched living, and sometimes their grown children are living at home longer, and their elderly parents. So notice that in 1980, multi-generational living was only 12%. Today, it's 20%. So builders are actually building homes to accommodate the sandwich generation of the boomers. And I think it's an opportunity to think about how could you capitalize on this new secular swing. So one of the things that is not really understood is that the United States as a whole is at inventory levels at 30-year record lows. What you see here is a ratio of the existing housing for sale market plus any new homes that are available for sale divided by households. And we look at this ratio, which is a little different than most of you think about it, which is the month supply. Talk about a balanced market is 6 months. And then if it goes below 6 months, you get pricing power. If it goes above 6 months, you start to see pricing pressure. So this shows you historically a trend line going back to 1983. You can see the peak of inventory was almost 4 million is what caused the great bust in terms of home prices collapsing. But right now, we're at such a low level that the market continues to see price appreciation, even though the luxury market is actually under pressure, which we can talk about more. What people don't realize when you see headlines, oh, existing housing is so weak, home prices are going to continue to be pressured because we're not seeing turnover. What this chart tries to depict is that actually the velocity of what gets listed and sold is at record levels, which is what we're showing you here. So in other words, I'm sorry, the graph is all messed up there. What you see is a record level of velocity. So at a certain price point, and the iBuyers have actually capitalized on this, that there is a definite seller's market below what we call a first-time buyer market. So if you're in a, call it 150 to 400,000 box, you would see multiple bids in many cities because there's not enough inventory in the market. There's a lot of frustrated buyers looking today. So we want to talk about affordability, because affordability, despite the media suggesting that we have a national crisis, we believe affordability to buy a home is actually pretty reasonable. How do we look at that? If we think about today, how many of you in the room are renters in this city today? It's pretty expensive. I can't believe only 2. You didn't all raise your hands, but I believe there's a lot more that are renting in this city today. What you think about is how much do I have to pay of my gross income to a monthly payment to make rent? When we look at this index, we actually transfer taking your monthly payment as a percent of mortgage payment as a percent of gross income, actually not including all the costs of property taxes. We create an index. And if it's below this 100 line, which it is today, predominantly due to mortgage rates, it's the median existing home price that you would have to pay, what would be the monthly payment as a percent of your gross income, considering only one household income. So 2 incomes actually create quite a lot more buying power. But notice today, simplistically, just looking at your P&L, we are still at very favorable levels. Doesn't take consideration balance sheet. This is an interesting slide. So if you look at the left, we survey 20% of the mortgage market. And what we ask the mortgage lenders every month that we survey, tell us on a 0 to 100 scale, how is the underwriting stringency? 0, you can fog a mirror and get a mortgage, which is what occurred back in the boom period. And 100 is you can't get a mortgage. So as you can see, right now, through 2019, we're actually pretty close to normalized levels for credit availability, which, by the way, is more important than what that actual mortgage rate may be or what that affordability slide I just showed you earlier, because if the mortgage market's not open, you're not getting a loan, no matter what the affordability picture I just showed you prior to that. So we really monitor this, and I would say that it's pretty reasonable right now. One of the things that you hear from lenders if you're trying to buy a home is what percent of your shelter should represent, or what percent of your income should go to shelter. And that bogey is about 30%. So if you look at the number of consumers in this country that are paying more than 30% of their income to shelter, right now it's about 32% through 2017, the best data that we could get. If we actually were to break that down further, what's really interesting is that owners above 30 through 2017 was only 23%. The real crisis is in the rental market. The rental market today, over 50% are burdened above 30%. And guess where that problem is the biggest? The California coastal markets and the New York market, representing 76% of the problem. So if there is a crisis, it's that we see rental markets continue to raise rents every year, and that's gouging the consumer, which is one of the reasons I'm really excited about co-living. I think co-living makes tremendous sense. I like rental availabilities that are flexible and more affordable to the consumer. Home improvement, we're at the later stage of the home improvement cycle. The home improvement market, we need redevelopment of homes, which is a major opportunity. We're not seeing enough of it. But what we're starting to see is if you look at discretionary spending, and people spend money on electronics, they spend money on apparel, furnishings, whatever you want to call it, for this cycle, home improvement was out-punching other discretionary spending. Personal consumer expenditures is the bucket that we look at. And right now, through the 2018, we actually are seeing home improvement underpunching overall consumer expenditures, which is actually correlated for the biggest correlation to determine home improvement spend is home prices. And home prices to home improvement spend, the correlation is 93%. And home prices, as you may know, which had been trending 5 to 6% per annum, is now running about 3.5%. So we like the home improvement market, but it's not as strong as it has been. We do a survey of manufacturers, distributors, and retailers, over $100 billion in aggregated revenues, so we can keep our pulse on the market every month and stay ahead of the curve. Here's the correlation depicted in this chart showing you the 93% that I just spoke to. One of the things that's interesting, and that gives me some comfort, if you're thinking about a next recession and what it might mean to your business, be comforted by the fact that I mentioned inventories at a record low. I kind of worry a little bit what happens if all the non-primary buyers in the market, whether we're talking about the single-family rental buyers, where we're talking about iBuyers, we're talking about fix and flip buyers, if that capital was to be constrained, how much would that inventories would be rising as a result of that. So a little thing to think about. But the other thing that comforts me, inventories being low, we'll say that's a given, is that there's a lot of skin in the game. So roughly of the 76 million homeowners in this country, there's about 34% that don't have a mortgage, which is great. And you can see over here on the left, 52% have more than 20% equity, greater than 20% equity. So there's a lot of skin in the game. So I'm not worried about a repeat of the great bust that many people ask me about. So single-family rental, I think it's a great shelter alternative. The single-family rental market has actually institutions don't own as much, but look at the numbers broken down. So 68 million are owned by, of the total single-family market are owned. Of the rental market, you can see here 15 million, I said 16 million roughly. So it's actually grown a lot because of the bust, and the institutional capital entered the market at the bottom of the Great Recession. We can see that all the national single-family housing starts, they only represent 2%. You hear in the media, you'd make it think that they own all of it. It's still a very significant mom and pop industry. 97% occupancies. Today, we surveyed the single-family rental market with millions of homes that we're aggregating through property managers and owners and developers, operators. And what you could see in any analysis that we do is that it's a very, very constrained market, and they're getting pricing power, and they're giving consumers an alternative. And that's what the consumers want, but they want a better experience, because the old the old single-family mom and pop landlord, they didn't fix up the house. They didn't do anything for you. In fact, you'd be lucky if they come and fix your stuffed toilet or whatever you needed. Now, there's single-family rental institutional landlords will provide you 24/7 call centers. They'll give you the ability through a ring or lock technology that you can enter the house and tour it. It's a lot of good things for the consumer, reducing consumer friction. Multifamily, I'm a little bit more cautious on the multifamily. We have some sell ratings on REITs and the public equity markets, and why am I more cautious? I mentioned earlier at the beginning of the presentation that the multifamily completions are slightly above what we think is normal. But if you actually look at what's going on, which is kind of concerning, is that the backlog of the units that have not been completed yet is at 3 multi-year decade highs. And so as that amount of completions come to market, and it's been very slow to market, which has enabled the REITs and all the overall apartment guys that have been just drinking the Kool-Aid, there's a wall of capital chasing this asset class, when in fact that starts to come to market, it will impact lease rates. So anybody in the rental market that's currently enjoying some nice growth, because the rental market's been very robust, needs to be aware there's a lot of supply coming, and it could impact you. Just finishing up on residential investment, really I want to talk about the areas. The biggest new revolution to the residential market, which has actually been really fun because it's kind of boring after 30 years doing the same crap every day, listening to the same companies I've always covered, to have something exciting. And I think that what I love about the iBuyer market, it really reduces the consumer friction. I don't know any of you, but I have 3 kids, and I've sold a house when they're little, and it's a real pain in the ass. I mean, you got to clean the house, you got to get the kids out, then they tell you that we need the house to do the open house. I would happily hand over my house at a discount to what perceived market value is, to just get rid of it and not have to deal with all that. So I think that really is something different for the consumer, providing them liquidity, providing them an experience that's much more positive. Whether the business model is going to prove to be successful, I'm a little bit more skeptical about that. Because what the iBuyers don't appreciate as much as I think I do is that it's tough, it's easy to buy and sell when you're in a seller's market. It's much more challenging in a buyer's market or even a balanced market, because consumers, you can't model what consumers' behavior is going to be. I learned that because all the economics or all the economists that were modeling that we were never going to see home prices go down. We were like, bullshit. The home prices are going to go down. And we were talking to what was the industry executives throughout our mosaic that we agreed that models will not determine what consumer behavior is. So that's something we're going to be watching. We talked a little bit about the REITs. One of the things that we're seeing right now, which is really exciting, is something called build to rent. So our builders are starting to take advantage of the fact that that gap, that there's not enough single-family supply, that they can now build homes and the consumer will rent it, which is a nice counter-cyclical revenue stream for them. But there's lots of opportunities out there because the elongated cycle and that need for that product doesn't matter if you own it or you rent it, but they want brand new. They don't want that old house that with all the dated product and the dated wallpaper and carpet. So that's an exciting area. And residential development, there's some big players in there. I don't know if you know Genesis Capital, they're Goldman Sachs. You have Glorilla Capital. You have also, I didn't put it on here, but you have Blackstone that are hard money lenders providing capital to redevelop our stock. Our stock needs to be redeveloped in this country. If you haven't started your startup or you want to pivot, which many of you guys do, I would be looking at the redevelopment market. I don't mean that to insult you. I'm just saying that I'm aware of that. But I think that there are great opportunities, and there's not enough for them. I found out there's something called the Hard Money Lender Association. I didn't know that existed. There's 500 hard money lenders. Now, myself and my mortgage analyst, who's in charge of mortgage research, we're meeting with them because I can go to one redeveloper at a time, or I can go to the hard money lenders that have 50 clients and capture a lot more information about what's going on in that marketplace. So it's evolving, but I think these are some of the areas where really the capital is chasing opportunities, and I think they're good opportunities. And with that, I will lastly give you what happens in a recession. Hear that question all the time. Wall Street, it's funny, when 2016, when China was blowing up, the world was melting, but Main Street didn't get the memo. It was fine, nothing was wrong. But what happens in a recession? What we show you here is that the fear of recession is now at record levels, according to the Wall Street Journal poll. So are we gonna have a recession or not? Last week we were, this week we're not. All I care about every morning when I wake up is what is the 10-year yield doing, because that's where mortgage rates are priced off of. And one of the things you'll see, if you go back and look at the year-over-year change in home sale dollar transactions, adjusted for inflation, I think that 1995, it was down 3%. When you think down 3%, which was when the Fed tightened and rates went up and the market felt really bad. I remember because I was a first-year analyst and it really sucked because I was not sure. The interest rates are really what matters to equities. Whether they matter to fundamentals is another story. But if you go back in that inventory slide I showed you earlier, inventories were much higher in 95 than they are today. And there's much more skin in the game today than there was back in 95. So for our perspective, we would have a muted housing decline in the overall economy because we're not leading the overall downturn. You go back to 91, 92, 81, 82, housing led the downturn, but this is not likely to be a housing-led recession. And one last tidbit, because I know I'm being told I have to get off the stage, is that if you actually look at the thing that worries me the most right now, and I'm a neurotic person and worry all the time, maybe that's good, that's why I'm good at what I do, is that interest rates, as we see the 10-year move higher and the mortgage rates move higher, what percent of homeowners today in the United States have a mortgage rate below 4.5%? Can anyone guess? Okay, I don't have enough time for you to guess. I'm going to tell you. 60%. You know what? The number of homeowners that have a mortgage rate below 5% is currently 75%. So when my girlfriend in Cleveland that's, bitching about her house and she's like, it's really bad, I can't take it anymore, I want to move, and it's a nice house. She's been there 15 years. She's ready to move. Her kids are off to college. Guess what? She has a 3.5% mortgage rate. She's not going anywhere. So there's an impediment, and people are staying in their homes, which is the backlash of all the refis we've seen. Something to contemplate, and I guess I'm done, and I should take questions. Thank you.